Good morning, everyone. Welcome to Olive Gaea's webinar on navigating carbon footprint assessment for businesses. I'm Jessica Scopacasa. I'm the co-founder and CMO of Olive Gaea, and I'm really honored to be your host for today's session. This is the first of a series of free webinars that we are organizing to help the regional business community navigate through the complexities of carbon footprint management. We will have some more webinars coming up. The next ones will take place in March and April and will focus respectively on managing greenhouse gas emissions, so target setting, emission projections, decarbonization, and net zero strategies, as well as then tackling Scope 3 emissions in particular, from supply chain engagement to decarbonization of the entire supply chain. We will anyway provide further information on these sessions later today and in the coming weeks, so stay tuned. And we really hope that they will provide some practical insights and strategies for businesses like the ones that you represent to reduce their carbon footprint. We decided to host these educational sessions as we feel that the need for businesses to effectively manage and reduce their carbon footprint has never been more pressing. With the effects of climate change already severely affecting communities and economies around the globe, and also with new regulations coming up and the business case for sustainability, which is growing stronger every day, this is really the time for organizations to take proactive steps towards sustainability and net zero. So, before we begin today's session, just a few housekeeping points. First of all, of course, we welcome questions at the end of the presentation. So please feel to drop your questions in the chat box that you see on the platform. We also have a few poll questions that we prepared for you, including one about your thoughts on the webinar. I want really to stress that your feedback is really important to us and will help us improve our future webinars and offerings. So please do let us know what you think about today's webinar. We will also share today's presentation with you at the email address that you provided at registration after the webinar. So again, you will be able to go through the presentation as per your needs. Now, let me provide just a brief overview of Olive Gaea. If we can move to the next slide, please. So Olive Gaea is a Dubai-based climate tech company, and we have a very clear mission to close the climate action gap. For those of you who are not that familiar with us yet, we have cutting-edge technology solutions as well as bespoke consulting services that help businesses take real and science-based sustainability action. Next slide, please. So as mentioned, beyond bespoke consulting, we have some tech solutions, including our flagship platform, Zero, which provides a comprehensive solution to measure, monitor, reduce, and report carbon footprint, as well as other key ESG material topics. The main goal of this tool, of this SaaS platform, is to simplify carbon management, decarbonization, net zero, and ESG reporting by leveraging technology and artificial intelligence. Now, moving on to today's webinar agenda. Next slide, please. Right. So what we will cover today is, of course, the issue of climate change. We will look into the business case for carbon management. We will define a process outline from baseline setting to net zero. We will introduce you to the Greenhouse Gas Protocol, and we will delve into Scope 1, 2, and 3 greenhouse gas emissions. We will look into the greenhouse gas inventory design and development, carbon accounting approaches and boundary setting, emission data sources, third-party validation, and finally, we will look into the key challenges and solutions to carbon management. So without further ado, since there's really a lot to cover today, I'm very pleased to introduce Vivek Tripathi, our co-founder and CEO, who will guide us through today's discussion. Vivek holds a degree in chemical engineering from the esteemed Indian Institute of Technology and furthered his education with a master's in business in the energy industry. With over 17 years of leadership experience, Vivek has held influential senior roles at renowned organizations, and his expertise will provide valuable insights into navigating carbon footprint assessments for businesses. So thank you all again for joining us today, and over to you, Vivek.
Thank you very much. Good morning, everyone, for joining in. So this is the start of webinars, the series of webinars we would be starting in to help businesses basically navigate through the maze of carbon management and improving on their ESG KPIs and reporting. So in the very first webinar, we would be setting up the context around carbon footprint management and the carbon footprinting for the businesses. Just to set the context right, how we see and how businesses today are seeing the value of bringing in sustainability to the center stage. And here are some key stats which are all referring in the direction that how sustainability has gained importance in the boardrooms, be it stakeholders internally or externally. Businesses need to really see the value in terms of doing business in a sustainable way. As we can see that the whole market valuation or capitalization of the company, the major element of that constitutes of its brand equity. And that's, we can see that even in case of UAE, this whole brand equity element is taking a major share, like 73% of overall valuation of the company gets defined by the overall brand equity or the brand image that it has. Sustainability has a key role to play to make the brand strong and sustainable in the views of its customers, its stakeholders, its suppliers, the larger ecosystem the business plays in. Consumers, of course, as we can see that with the growing interest and from the consumer end, they are looking out to buy or sort of do businesses with such organizations who are taking a very positive action towards sustainability and climate action commitment. So that's where we see a very strong foundational case for businesses to really look at sustainability as a core of their business. Moving on from there, just setting the whole process here from baselining to net zero, how the whole process gets worked for a business. We put it in a form of a cycle here. We can see that the very first step is, of course, to establish the baseline of the emission the business has. This is effectively saying it is mapping or monitoring, or probably starting with where you stand in today, where the business stands in today. With no intervention done, how exactly a business is contributing greenhouse gas emissions to the climate. So that's the step one. This is the diagnostic. Once you do the diagnostic, comes the step two, where you try to find out how your emission is going to look like in business as usual scenario. If you do nothing with respect to sustainability, you don't improve your business practices, how your emission is going to grow as business grows. So that helps us put together a sort of an emission projection altogether. Once you do understand your current status, how emissions going to grow in future, is where you start looking into your emissions sort of break open in front of you, where you know that what elements of your business are contributing the maximum amount of, or sort of having a lion's share in your overall carbon emission as such. That helps you to identify what sort of targets that you want to set. So for a business, particularly as we interact with multiple such businesses who are at a stage where they want to set a reduction target, there are a couple of sort of guidelines through which you can do it. Either you can get to the frameworks like SBTi, which is Science-Based Target Initiative, or you can align yourself with the government, the overall government's target as such. So those are called nationally determined contributions, NDCs. For that matter, UAE, KSA, India, China, US, UK, all these countries have set up their respective NDCs. So businesses can set their targets in line with the country they are operating from. The step next comes is setting an offset target. As we understand that while the whole space around decarbonization is ever evolving. More technologies are coming, new ways of doing businesses are being explored. We still believe that there is some amount of emission with the business remains completely unabatable, and that's the part of the emission that can be managed by the way of setting some reasonable and credited, verified targets around offsetting. The next step after that is step 5, where you look at your progress against the target set and sort of decarbonization that you have put in place, how it's performing vis-a-vis your overall target of net zero. And accordingly, you adjust your strategy year on year to see that you stay close to the target that you have set for decarbonization. Eventually, with this is where you lead towards sort of your net zero strategy. This again could be a short-term, a medium-term, or long-term strategy. Short-term, typically it's taken like something around 2030. The long-term to medium-term could be somewhere around 2040 to 2050 sort of net zero targets. So that's sort of a cycle with which you can set your journey towards net zero. The next aspect is how basically this whole assessment needs to be done and how the carbon accounting gets done. To set common principles around for all type of businesses, one has to follow a standard or a particular framework or a protocol. Here in case of greenhouse gas accounting, the mother document is Greenhouse Gas Protocol. Now, Greenhouse Gas Protocol is globally accepted by all businesses alike when it comes to identifying that how their emissions are looking like. Now, Greenhouse Gas Protocol, it has been developed by World Resource Institute and World Business Council for Sustainability Development. However, these two entities, the non-profit entities, have come up and set up this Greenhouse Gas Protocol, but it had been ratified by all government agencies, and starting from Paris Climate Agreement, the United Nations. They all support Greenhouse Gas Protocol. So this definitely, the Greenhouse Gas Protocol is the most established and industry-wide used practice when it comes to do the carbon accounting or baseline assessment of greenhouse gases. Moving on from there, let's just look into the aspect of how the emissions are basically categorized. So broadly speaking, there are 3 categories of emission that a business could have. One is around scope 1, scope 2, and scope 3, and we'll look more deeply into these scope of emissions. But before that, let's take a closer look in terms of when we say that greenhouse gas emission, what it all entails. So greenhouse gas emission, or more commonly used as CO2 emissions, these are basically not just carbon dioxide emission, but there are some other greenhouse gases also which form part of the overall greenhouse gas emissions. So as you can see on the top of this picture, there are 6 different gases which are mentioned out there, starting from carbon dioxide and going to sulfur hexafluoride, and in between there could be hydrofluorocarbons, perfluorocarbons, nitrous oxide, and methane. Now all these gases are basically called as greenhouse gases. But eventually, when it comes to the carbon footprint, what you do is that you basically evaluate all the respective emission of these gases and convert them into carbon dioxide equivalent terms. So for that matter, burning a particular fuel might give a maximum amount of carbon dioxide emission, but it might also have some amount of methane emission. Similarly, certain industries might be emitting sulfur hexafluoride. For that matter, like as an LED industry, we talk about it, there's a good amount of sulfur hexafluoride emission happens there in the LED manufacturing as such. Now, all these gases, how they convert into carbon dioxide equivalent depends on their global warming potential. Now, what exactly is global warming potential? It is a measure by which you can relate that particular emissions the lethal impact of that on global warming in terms of carbon dioxide. So for that matter, every ton of methane emitted, it's almost equivalent to 27 times or 27 tons of carbon dioxide equivalent. So this factor of 27 is the global warming potential of methane gas. If we go further down the line, SF6 for that matter, it is almost 24,000 times more lethal than carbon dioxide. Though the amount of SF6 emission is very limited, but think of it, even a ton of its emission would correspond to almost 24,000 tons of carbon dioxide equivalent. So like this, for every gas, you have got a GWP, which is global warming potential, on a time scale, and accordingly, you add all those respective emission of gases and add them up to make a carbon dioxide equivalent of emission. Now, this is about the gases which gets covered in the greenhouse gas accounting or inventorization. But now if you look at the various different scopes of emission. Now, again, take a business, and for that matter, the center of it, of this picture, where scope 1 is written, you can see that this is the reporting company. So let's say a particular business wants to come up with their GHG inventory calculation. They will look at the scope 1, which is what they are directly burning. If the business is buying certain fuel, whether for running cars or buses or for running the plant, and they are directly burning that fuel, is what gets accounted under scope 1. However, scope 2 and 3, they are sort of not getting burnt at the business site itself. However, that burning or that emission might be happening on some other site, but due to the business, that element gets attributed over the business carbon footprint as such. So that's why they are called indirect emission, or for that matter, very clearly, scope 2 and scope 3. Now, what all gets included in this scope 1, 2, and 3, we will look into the further slides. So for that matter, let's look at scope 1 first. So scope 1 has got these 4 major categories of emission falling under scope 1, which is one is stationary combustion. Now, stationary combustion is something when you have certain equipment or say some sort of a equipment where directly you need to feed in some fuel and burning is required. That's where the emission, whatever emission happening, would be called stationary combustion. A real example could be a DG set, basically diesel generator set. You have some site which is not connected to the grid, and you've got a DG set and you burn diesel in it. Whatever emission coming from that diesel burning would be falling under the category of stationary combustion. If you look at mobile combustion, very easily understandable. Everything which is mobile and burning fuel is all that emission would be falling under the category of mobile combustion. So your transportation, your cars, buses, all that emission would go under the category of mobile combustion. Process emission is something related to very specifically to chemical manufacturing company, fertilizer manufacturing companies, or refinery for that matter, or crude oil extraction for that matter. So these are all process emission. Process emission is by the way of whatever processing you're doing, there's some amount of gases which get evaporated or sort of leaked out in the environment. Those seepages, those leakages would be falling under the category of process emission. Now, process emission could also be one thing which we always see, that while driving on Sheikh Zayed Road, you might have seen there is a Diva plant and there is a flare stack. So that flare stack again is a part of the process emission. Whatever gases which are there recovered from the system and being burnt again generates a carbon dioxide emission. So that part of emission would go under the category of process emission. Fugitive emission, as the name suggests, anything that gets not purposefully but gets leaked out in the environment falls in the category of fugitive emission. A right example would be like in the central air conditioning plants, where you have a lot of these hydrofluorocarbons, perfluorocarbons being used as coolants. That's where these coolants get released into the environment because of the temperature difference, and hence all this directly contributes into greenhouse gas emission again. These 4 categories together summed up as a scope 1 or direct emission. Why they are called direct emission? Because in some ways, this is still under the control of the business, because this emission is happening on the business site itself. Wherever you are conducting your business, that is happening there, right? In the case of DG set, yes, that's a construction site of yours, and you are burning diesel and generating emissions out there. That's under your direct control. You can choose to probably switch to grid power or switch to some other source of generating that electricity and can completely avoid it. So from the purpose of how much control you have over those emission gets defined that whether it is a direct emission or indirect emission. Coming to the next, which is scope 2 emission. Pretty straightforward in that case. A scope 2 emission is whatever you are purchasing. In the first case, is scope 1, whatever you are burning. The scope 2 emission is more about whatever you are purchasing. So you purchase, typically business purchase electricity, business purchase energy, sometimes some industrial units purchase steam, right? So they are buying heating that ways. Or in our case here, most of the businesses get cooling fed by Empower or Mcool or various different suppliers who are supplying cooling to you, right? So all those emissions which are related to you purchasing that energy and use it falls in the category of scope 2. So very simply, while my business is running and getting fed by a Diva grid, and I don't see any emission happening because I'm just switching on a light or probably putting my AC on. But think of it, whatever electricity that you're consuming to run lights in your business or probably have cooling in your plant, somebody is burning somewhere to generate that heating or cooling for you, right? Or probably electricity for you. For that matter, Diva might be burning various different fuels and generating that electricity, generating steam and running steam turbine and basically generating electricity and feeding into the grid, which you are taking. So this sort of emission, which doesn't happen at the business site, but it happens somewhere, but due to your business needs, you need to buy that energy, heating, cooling, electricity. You are contributing to that sort of emission in an indirect way. So that's why these category of scope 2 emissions are called indirect emissions, and this has these two elements. Now, coming to the most or sort of how it is perceived is the most complex part of emissions, which is around scope 3 emission. Now, recall that picture that we were seeing earlier, where the central arrow was your scope 1 or direct emission, and scope 2 and scope 3 emissions were on the left and right, right? Now, scope 3 emissions are typically, which is not core of your business, which could be upstream of your business or downstream of your business. So what for a business is upstream and downstream? Let's say I'm an apparel manufacturer and I make probably jeans. To manufacture that jeans, I need clothes to be bought, right? I need cotton to be bought. I need denim to be bought, right? So now all that elements that I'm buying, it is part of my upstream part of the business, right? Sourcing part of the business, whatever raw materials that I'm sourcing. Or say tomorrow I'm a fabrication company and I fabricate probably some metal pots or something. And to be able to fabricate all of that, I need to buy lathe machines to basically cut the whole structure or cut the metal. In that case, that lathe machine is being delivered by some lathe machine manufacturer in China. Now that again is a purchase which is upstream of your business. Like before you have even process or manufacture your good, you need certain capital goods to be put in place, some machinery to be put in place. All that sourcing of machinery, all of that is your upstream part of the business. The downstream part of the business, in both these cases that we just talked, it could be the end product, right? Whatever the selling that needs to happen. Let's say if I'm manufacturing jeans and I have a retail operation as well, then in that case, I'll be taking the jeans from my manufacturing plant and would be putting that in the retail store so that eventually customers can come and buy it there. Similarly, those steel pots that I'm manufacturing at my manufacturing site, downstream it might be in some of my warehouse or storage, I might be storing that up. That is downstream part of my business. So you can see that in scope 3 again, there are 15 subcategories, and all of this related to either upstream of your business or downstream of businesses. Apart from that, there is some element of business travel that comes in. Now, employees need to travel for business. In that case, they will be taking air flights, they will be staying in hotels. All of that part of emission, I mean, you flying or like a couple of your employees flying in, they are again flying with an aircraft which is burning some jet fuel or aviation fuel. All that emission falls in the category of business travel. Simply in the similar way, employees might be going to multiple different offices, and all that driving that they are doing from their homes to the offices, respective offices, all of that emission would fall in the category of employee commute. Similarly, there are other categories, as you can see that there is in fuel and energy purchases. Now, as we were talking about earlier, that In scope 2, all of your electricity consumption that you're doing, emission associated with it would fall under the category of scope 2. But if you look at the scope 3, this fuel and energy purchase, what exactly it is the upstream transportation and distribution losses. Now think of it, my business is simply getting connected with the grid, which is going above or nearby my facility. But bringing electricity from Diva's production plant where this electricity is getting generated, there will be a good amount of transmission of that electricity needs to happen through these high tension overhead wires you might have seen all across. All that transmission always have some amount of transmission losses. Now, if assume a scenario, you had not required for this, you didn't require this electricity, then Diva would not be transmitting all of that to your doorstep or your factory site as such. Now, this transmission losses, whatever is happening, for that loss also, there is some amount of electricity which has been generated. So again, some emission are associated with those losses as well. So those losses would fall under the category of fuel and energy purchases. Capital goods we have seen before. Similarly, purchase goods and services, multiple items that you might be purchasing, be it the raw materials or probably stationary items or whatever your business is purchasing, all that would fall into the category of purchase goods and services. Similarly, there is some amount of financed emission that is also pertinent for financial industry as such. It could be banking, financial services industry, or insurance industry for that matter. Now, investment-related emission is something, how it is attributed is tomorrow, ENBD plans to probably give a debt to, let's say, a power plant, right? Now, giving that debt eventually would be helping that power plant owner to burn some fuel and generate electricity. Now, this is an assisted emission. Had ENBD not funded, not given debt to this power plant, in hypothetical scenario, that power plant would not have come, right? So that's the way how you calculate the financed emission. Whatever element of financing you are providing, whether it is to a project to get constructed or probably buying equities in a particular company or giving commercial real estate developers money to develop that commercial real estate as such, all of those investments from bank, right? It is assisting that particular entity in whichever business they are to generate some emission. And that's why this emission need to be attributed back to the bank to the extent they have provided the funding for. So in that case, if the power plant needed 100 dirhams to construct, like hypothetically, and Emirates ENBD had given, let's say, 30 dirhams in that out of that 100, then whatever that power plant's total lifetime emission is, 30% of it would get contributed under ENBD's financed emission. So that's how you basically follow the money principle and see that where the money is going and what that money is doing. Eventually, it is helping them construct and burn fuel and generate emission. So that's how you follow the money principle and go to the financed emission. Similarly, there are other set of emissions as well, which can be covered under the scope 3 emissions. Moving on from here, GHG inventory design and development, what exactly does that entail? So this is basically starting from scoping and planning, where you really find out that what standards you are going to use, what sort of organizational and operational boundary you're going to set, what is the base year that you are thinking of. Then comes the data collection part, where you look at sort of all data that is needed. As you have seen, we are almost talking about 6 and 21 odd different categories of emission. Every emission need to be calculated based on the data that the company provides in. So all that data collection exercise happens and eventually come down to a stage where you can start quantifying the emission based on the emission factors which would be required to be used there, and eventually putting up all the activity data or the spend data and coming up with the overall emission as such. If I look at the accounting approaches, as we were seeing earlier, basically the carbon accounting approaches are broadly split into two types, like activity-based approach and spend-based approach. And I'll give you an easy example to connect with it. Say a company buys 1,000 liter of diesel to burn in DG set. Now, this 1,000 liter of diesel is in activity data. However, on the other case, there is company B, which provides the data that saying that I buy 20,000 dirhams worth of diesel every year. Now that's the spend data. Both of these data points are good in their own standing and can be used to calculate carbon footprint. But as you can see that in the activity base, you are very clear that what exactly is the fuel involved in it, what is the total quantity, and hence you can very accurately calculate what is the carbon emission associated with it. So as you can see that activity-based approach is more accurate. It also helps you in decarbonization, because think of it, when you know very clearly that in what activity, what type of fuel is going, you can always look at the replacement of it, which might be having lesser carbon emission. So it always helps in when you are planning to decarbonize your operation, activity-based calculation is always preferred over the spend-based. It is more compliant, of course, it has to be, because here you are talking about very specific emission factors for that particular product being used at a particular location. However, the downside is, of course, it's going to be time consuming, because you would be really looking out for each and every product or like the quantities that you are consuming in, and eventually calculating the whole carbon footprint. Spend-based approach, on the other hand, it uses emission factors which are called as coming from EEIO database. What EEIO database is? This is environmentally extended input-output model. Now, EEIO database is like a sort of a cross-region or cross-country sort of an input-output model. What a country imports and exports, there is a balancing done in that. And from there, you find out how exactly every dirham or every currency, every amount of that being spent, what is the associated emission with respect to that activity or product. So that's again a very, very extensive sort of a multi-region sort of a database. Now, as it might sound very clearly, this is definitely not the most accurate number, but this gives you an estimate, right? So tomorrow, if I say that I buy 1,000 dirham worth of diesel every year, there would be, from the database, we can very clearly find out that for the diesel, what is the carbon emission in terms of kg CO2 per dirham spent against diesel purchase. Now, from there, you can always estimate that what is the total emission associated with that purchase. Now, as it suggests, it becomes pretty easy. You can simply take out your whole spend sheet in one go, probably from your ledgers, and you can simply calculate against each purchase a certain emission factor based on the economic intensity, and you can come up with that number. This is less intensive, of course. It is good for making a high-level estimate, and it's also good for emissions which are not very pertinent or which are not very critical for your business. A long-tail emission, which is like the supplier of your supplier of supplier. If you wanted to calculate the emission for that particular supplier, which is down the line, way away from your business, use this sort of an estimated method. Prone to greenwashing claim? Of course, yes, because here you are using some sort of a country level, region level, or probably multi-region model to estimate what is my emission, which I might be doing in UAE, which might not be very relevant, right? So it is again having some amount of greenwashing claims that you've not calculated your actual emission, but you've taken some regional numbers or probably multi-regional numbers, and from there you are telling your emission is X tons. So that's where it has got challenges there. But if you look at the hybrid approach, this is the most practical and pragmatic way to come up with your whole carbon footprint or baselining, where you take activity data and whatever data, wherever you are not finding any activity data, you look out to get some spend-based data and move ahead with your overall inventory calculation. Now, boundary setting, again, this is a very critical exercise to be done at the start itself. There are two sets of boundaries that one needs to set. One is the organization and the other one is the operational boundary. What exactly is organizational boundary? Is basically for entities who have got a sort of a detailed organogram, right? There could be a parent entity and there could be multiple subsidiaries, project offices, associate companies. There could be multiple such entities below the parent entity. So what you need to do is that since you're doing the carbon accounting at a parent level, you need to really see that how these multiple subsidiaries, associate companies are linked with the parent company. Do they have a direct relation in terms of the parent having some equity in it, or the parent having what sort of control that they are having? So that's how the organizational boundaries are set by two methodologies. Either you can take an equity approach or you can take a control approach. Equity approach is very simple. Simply to say that if the parent company holds 20% equity in subsidiary A, then whatever subsidiaries A emissions are, if you have chosen equity approach, 20% of that would go and basically sit with the parent entity's overall emission. However, in the control approach is, as the name suggests, if the parent entity has a complete control of the business, be it financially or operationally, then it should consider 100% of that subsidiaries or associate companies' emission into its overall inventory at parent level. Now, control meaning to say, when we say operational control, it is very well understood that whatever operational decisions are happening in that entity, in that subsidiary, it's been completely driven by the parent, right? In that case, whatever that emission that at a subsidiary level is happening, the main reason the operational philosophy is defined by the parent itself. So all of that emission should always go and club into the parent entity. Financial control is very well understood. Like if you have 100% control financially over a subsidiary, then whatever that subsidiary's emission, it should all 100% go into the overall parent. Now, this is very important. Why it is so? When we are talking about multi-entity structure, we need to really, first of all, understand what is the relation between multiple entities out there. Once you have clarified that, then you can come up with a very robust sort of an overall carbon accounting at a parent level. And that is why you need to define your approach, that which approach you're taking and how you're going to consolidate all of that inventory. Operational boundary, as the name suggests, as we have seen, that scope 1, 2, 3 together had got some 20, 21 odd categories. There would be certain set of categories which might not be relevant, right? A very clear example would be that if I am not into funding investments, then anything related to financed emission is not pertinent to me, right? So I can leave that. So that would become my disclosure. While I publish my report and say that my carbon footprint has been X tons, I will disclose it very clearly that my operational boundary didn't have, let's say, emission by financed emission or probably some other emissions related to energy purchases. So I can exclude out what all is not pertinent for my business. So that is again a business's responsibility to define very clearly what all emission would be accounted for when they put up the whole inventory calculation as such. So that's how the boundary setting is done. If you look at the next part comes in the emission data sources as such. Now, as we can understand that pretty much any assessment that we do, there are always two ways to it, right? Get to the primary data or otherwise look out for some secondary market data, benchmark data, peer data. So there could be multiple such approaches there in the secondary data. Now, as the name suggests, and for the purpose why you're doing all of this is to establish very, very scientifically what is my carbon emission, what is my total carbon emission of the business. So preferred always is to look out for primary data sources. You directly go to the source of emission and find out exactly what is the level of emission or what is the level of consumption that I'm having of that particular fuel. And accordingly, I calculate my complete emission. The reasons are, of course, that this is for all high priority activities. Whatever my business, if let's say I'm a utility company, I'm generating electricity. My core of the business is basically generation of electricity by generating steam, and for generating steam by burning some fuel. That is core of my activity. Now, my employee commute for a utility company, it could be definitely very high, but it could be, let's say, some leased facility related emission. This might not be very pertinent for me, like not very critical business operation for me. So I will rather put more focus of primary data when it comes to burning that fuel, but related to any sort of a leased out facility and that sort of emission, I might still live with some secondary data available. So that's again why it is done. It is done to basically so that you can put more focus on main critical activities of the businesses and get accurate around those emissions. For rest of the data points, for rest of the emissions, you can still look at for some sort of a secondary data. The reasons, as the name suggests, of course, preference is more to give primary data, but wherever it is not available, a secondary data, a market database, or a published report can always be used to benchmark the emission of that category as such. Coming to the next point, which is around the role of a third-party validation. Now, as we can understand it, it is something similar. A parallel example could be that every company has typically gets a financing team, a team which runs around the finance, accounts, taxation, and they've got a team which prepares like all the financial statements, right? As on the end of the financial year, this is the balance sheet looking like, this is cash flow, this is profit and loss statement, this is income statement, all of that's prepared. But what exactly is needed for company to really publish this to some stakeholder, or probably reach out in the market and say that this is our this year's financial, is a third party auditing those numbers. Now, however, as a particular company might do its own calculations of carbon footprint, or might engage some third party to do that calculation, it's always advisable that you get that particular inventory third party sort of validated. Now, that third party validation only ensures that everything gets aligned with the GHG protocol. If you're going out for some sort of ISO certification, then there is a specific ISO 14064 3. As per that, you can always get your inventory third-party certified. Now, beyond this, there is always in certain markets where there are regulatory requirements. Whatever you submit, you provide that whether it is third-party validated, certified or not, right? You tomorrow go for probably your CDP reporting. In that scenario, it is preferable that you have your third-party certification done. So that's where it sort of gives more confidence in what you are saying when it is third-party validated. Of course, it brings in more sort of a better brand reputation, that whatever you are publishing, it is always third-party certified, validated. Increases the stakeholder confidence, whether it's your investors, whether it's your board, whether it's your employee. They say that, yeah, this is coming up with a validation. Yes, the numbers are close to accurate. Goal setting and alignment, of course, the major focus here is that while you are setting up your trajectory for net zero, it is always good to be doubly sure of where your starting point is. So baseline is your starting point. This is the time where you are first time setting up your inventory and you want to set some reduction target. It's better that you get completely assured that everything is in line with the protocol, everything is in line with ISO standards. And that's the reason the third party validation is always important. Now, until so far, this is pretty much that gets sort of covered when we talk about the greenhouse gas protocol or carbon footprinting exercise. But if we look at it in terms of whatever we've seen so far, our experience says, and there is a survey done by BCG, says that 91% of the businesses actually fail to measure their emission. And this is precisely the reason, because there are certain complexities around various different emissions, how you account for it, how you consolidate it. And that's where businesses fail to actually come up to that. While the businesses 91% fail, 89% of the companies who actually are good at probably establishing their footprint are unable to achieve their targeted emission reduction. And this all goes back to the fact that while you run your whole exercise of inventory calculation, you always find it challenging to justify that how your decarbonization measure is going to be taken up. Here comes our product Zero. So what we've done is that we've come up with this SaaS platform. This is for complete your carbon footprinting, or sort of a complete ESG reporting framework that it provides, starting from measuring your footprint, helping you set your net zero targets, set up your decarbonization roadmap. Whatever residual emissions that you could not manage from decarbonization, you can look out for offsetting that through a marketplace being provided in the tool, and eventually come up with your complete ESG sort of a monitoring, like whatever KPIs that you've set around your ESG goals, you can monitor all of that and report as per various standards. It could be GRI, SASB, or probably PCAF, or it could be CDP. So whichever framework that you suggest, the tool has a capability to help you come up with the reporting for that. How it's done is, as you can see, that this is one of the screenshot from the tool itself, where it gives you a complete overview of your overall emissions, your scope 1, 2, 3 emissions, look at various different suppliers which are contributing to your emissions, and basically look at your peers, how your peers are doing with respect to the same category of emission as such. So eventually, what Zero does here is basically helps you do a better measurement, which is in line with the science and which is in line with the various protocols, the frameworks. It helps you engage with multiple data owners as such, so helps you engage within the teams. It improves overall efficiency, because our experience says that it cuts down your time resource requirement by more than 85% when it comes to doing a complete net zero road mapping. eventually helps you improve your traceability because every data point is tracked to the source, and that's where the traceability around your overall emission is really very high. It gets you prepared a complete audit trail ready roadmap or the carbon footprint assessment, and that's where it is sort of highly auditable that ways. Helps you eventually take a sound decision around your ESG leadership. Open for Q&A here. Thanks, Jessica. Back to you.
Thank you very much, Vivek. Thank you so much. So yeah, we are now open to your questions. Feel free to type your questions in the chat box. We'll do our best to address them. While we wait for questions to come in, just a kind reminder, if you haven't done so already, please head to the poll section. Let us know what you think. Share your feedback on this webinar also, as this will really help us refine our future webinars. So yeah, let's look at the questions in the chat box, and let's see if something is in. Okay, I have a question here. What emission factors shall we consider when assessing our carbon footprint, and where can we source these emission factors?
Right. Yeah, sure. Thanks, Jessica, for the question here. So in terms of emission factors are the backbone of the complete emission inventorization that the business might be doing. Emission factors are basically are represented in form of kg or ton of CO2 with respect to every unit of that particular fuel or electricity or product that you are consuming for the business. So that's where the emission factors are coming from. Now, if I talk about the emission factor, there are multiple data sources from where you can get it. So US Environmental Protection Agency, US EPA, comes up with its own set of emission factors for scope 1, 2, 3. Similarly, DEFRA, which is the regulatory authority in UK, comes up with their own set of emission factors. Beyond this emission factors, there are set of globally recognized databases like EcoInvent. EcoInvent comes up with their proprietary sort of a huge database of more than 24,000 products all across the globe from various regions. It tells specifically what is the emission associated with each unit of that particular product being consumed. So yes, there are multiple data sources, databases, which one can rely on. Beyond this, there are certain set of data sort of emission factors which need to be calculated very, very locally. So in that case, if I talk about within UAE, the grid has a specific intensity of carbon emission. So when it comes to consuming electricity from the grid in UAE, you need to really consider that what DIVA's emission factors are, or for that matter, what is the emission factor which is associated with Abu Dhabi grid, or for any particular Emirates for that matter. So that's how you come up with various different emission factors to be able to accurately fix emissions.
Thank you, Vivek. We have another question. How do we address the risk of double counting greenhouse gas reductions if my organization's scope 3 is someone else's scope 1?
Right. A very good question that way, and thank you very much here. And this is a fair case that if I am talking about my whole scope 1 emission or probably my scope 3 emission, this would be the case when it comes to your scope 3. Let's say you are procuring certain good, and while that particular vendor's sort of whatever supply that they are doing, you are calculating your whole scope 3 emission around that particular supply. When it comes to finding out the avoidance of double counting, here, look at it. I mean, your scope 3 would be your suppliers probably scope 1 or probably scope 2 around energy consumption as such. Now, your scope 1 and scope 2, you are only contributing to the extent of the purchase share. So to put this in example, I buy from vendor A goods worth 100 dirham. Now that vendor A's total emission intensity based on, let's say, economic intensity, right? And that particular vendor A generates 1,000 dirham worth of turnover every year. Now, in that 1,000 dirham, your contribution had been 100 dirham, which is effectively 10% of their total emission is being contributed by your purchases. Now, if that vendor provides you their whole scope 1 and scope 2, what you're going to account into your emission would be 10% of that total emission. So actually, the vendor is providing you that 10%, and that is what you are accounting into your sort of overall emission. Now, when we talk about decarbonization, because the question second part has around that sort of a double counting around decarbonization. First of all, there is no such sort of an effort which could be at this point of time avoided when it comes to really decarbonization, because whatever we do is still falling way shorter than what the global ambition of 2030 is to cut emissions by half, right? And when we talk about scope 3 emissions per se, the major element around your scope 3 emissions decarbonization would be to engage with your vendors, which is again, like as per Science-Based Target Initiative as well, the target around your scope 3 emission reduction is one of the ways to set that target is to have your supply chain engaged in a form that they set out their emission reduction target. Eventually, this particular case only, if that vendor's total emission was 100 tons and like 10 tons of it is getting contributed in your scope 3, your target would be to help him cut their own set of emissions, right? By way of setting some targets, first of all, doing a proper baselining exercise, and eventually helping them reduce wherever emission that can be reduced. So that's how you are helping your vendor to cut its emission. And eventually 10% of that contribution, which is coming into your scope 3, would also be in the same proportionate amount it would get reduced. So that's how the whole chain of my scope 3 and scope 1 works. But as I said earlier, I mean, any particular target, if two entities are contributing towards same set of emission and setting up targets around decarbonization, it eventually is going to only help the whole ecosystem. And the target anyways is way too aggressive, despite multiple entities putting same set of decarbonization levers in place. I hope this replies to your question.
Thank you, Vivek. Another question is on carbon capture and storage. So how promising are these emerging technologies, and how significantly can they mitigate emissions from fossil fuel combustion?
So CCUS, for that matter, has been it's a dated technology. It's been already there, right? I mean, I can say for sure that people who are coming from an oil and gas background, they would know about something called EOR, which is called enhanced oil recovery, and that's precisely what carbon capture was, where you capture the carbon dioxide in the environment and you pump that into a reservoir so that it improves the reservoir performance or sort of improves the production altogether, right? So that pumping and probably storing that carbon dioxide within the reservoir itself, subsurface, that was one of the ways by which this has been done. Now, carbon capture and underground storage, when we talk about it, it had got a huge potential that ways. And as we can see that ADNOC already had got a huge plans around coming up with almost 10 million tons, if that's not been updated recently, setting up a CCUS capacity around 10 million tons. Worldwide, there is a great amount of investment that's happening in Norway and other Nordic countries as well, and other oil-producing countries. CCUS definitely holds a huge potential, but when it comes to really looking at the economies of scale, or probably looking at the overall implementation cost today, it is still, I would say that there are other measures as well by which you can have your decarbonization plan in place at a relatively lower marginal abatement cost. The overall abatement cost per ton of CO2 with the way of CCUS, it still hovers around more than sort of, I would say that probably $500 to $600 in some cases, depends on which location we are talking about, with each ton of CO2 reduction. Vis-a-vis, there might be other avenues available, again, depending on the business where it is, what sort of business you're talking about. But yes, there could be other avenues by which the decarbonization can happen at much lower cost vis-a-vis CCUS.
Thanks, Vivek. There's another question. If you can provide an example for scope 2, heating and cooling emissions.
So as shared earlier, like heating and cooling assumptions that we are talking about here is pretty much the heating assumption is very clear, right? There are a set of plants who don't have their own boilers or generate a steam while they need it for the processing of their product. They secure a steam by companies who are having excess steam. So for that matter, you might be sitting next to a Diva plant and Diva might be having some spare or spent steam available at a certain pressure. So you can always secure a steam from those plants and run your process as such. Now, whatever steam that you're consuming, that would be basically used to calculate the overall emission, which is associated with that amount of steam. Similarly, the cooling assumption, that goes by the fact that the number of refrigeration tons that you might be procuring for your business to cool probably a warehouse or a storage facility or probably the whole office as such, all of that refrigeration tons corresponds to some amount of energy being consumed to generate that amount of cooling. Now, that is what it is used to calculate the emission associated with it. So for that matter, whatever MCool might be charging you month on month, if you can find out in your bill that what exactly my refrigeration tons consumption was, then we can always help you with the overall emission associated with that cooling element.
Thank you, Vivek. I think we answered all questions and time is up. So I would like really to thank you all for joining us today. Please visit our website or reach out to our team directly if you have any further questions or if you're interested in learning more about Olive Gaea and our solutions. We really hope that you found this webinar informative, valuable in your journey toward managing your organization's carbon footprint. And we really look forward to see you in March and in April for our upcoming webinars. So thanks again and have a great day, everyone.